I think, a true recession, you know it when you see it. And if we're still arguing about technicalities of a recession, if the kind of bearish take on this economy is that technically the economy is in recession, I think that's pretty bullish, actually.
It is now my great pleasure to introduce Dario Perkins, the Director of Macro Strategy at TS Lombard. It's good to see you again, Dario.
Good to see you. I'm impressed with your pronunciation.
I gave it a good shot, at least. Dario, let's start with the first things first. We're going to talk about the fiscal response to a potential recession today. But I guess the key question to answer before we get to that debate is whether a recession is a likely scenario or not. What's your take on that?
Well, at the moment, I've got investors asking if we're already in recession, which is a variant of that question. I think that this is a sort of fake recession, and it was something I was warning about at the start of the year, actually. It was one of my kind of big non-consensus ideas for this year, is that we'd have a summer recession scare. And, the fact that Google Trends of the word recession just hit an all-time high, I think proves that we have that scare. To me, a lot of this is coming from still massive distortions from the pandemic. We have a business cycle that isn't really a business cycle. We had people, sitting at home basically buying stuff off the internet. So we had this huge demand for goods, and it's shifting back. We're now going on holiday. We're now going back to restaurants. And so the demand for goods is coming off just at the point where you've got this kind of bullwhip effect through inventories. All of these retailers built up these inventories. So manufacturing, which is normally your leading indicator, is giving you this, this idea that we're going into a massive downturn. But I think a lot of that is sort of fake. It's a sort of distortion, and it's misleading a lot of people. And actually, when you look at long-term inflation probabilities in bond markets, they also drive from the global IP cycle. So you're getting this kind of pendulum that, between recession and inflation, which used to swing sort of every 2 years in the 2010s, is now swinging every 6 months, and it's causing all of these uncertainties and these narratives all the time in markets. And I think, a big part of this, again, is the fact that inflation is very high. And so you've got this destruction of demand, which isn't really destruction of demand, it's destruction of volumes. So, people are paying more for stuff, so they naturally buy less of that stuff. And, we haven't seen this sort of downturn in a very long time, because it's being driven by inventory chaos. And for decades, we had these perfectly managed inventories. And, we haven't seen this sort of instability in inflation before. So, it's very different to the sort of recession that investors have in mind when they talk about a recession. I think it's largely fake. And actually, a lot of this stuff should unwind. If inflation does come down, then real incomes are going to rebound quite quickly. And, we still have a lot of resilience in labor markets. I define US recessions by the labor market. There's massive labor shortages still. I just don't see companies firing workers in that kind of environment. And so the normal recession dynamic, which is that companies fire workers, they spend less, revenues go down, you get more rounds of firing. I just don't see that, materializing.
We'll get back to the definition of a true recession in a second, but I wanted to ask you about the inflation outlook first, because we received the first glimpse of hope with the latest CPI report. It seems as if inflation has rolled over a little bit, that the market has now clearly started chasing this story of disinflation. Do you think the market is right in assessing a larger probability of a soft landing by now?
Yeah, I mean, you're sort of asking me if it's peak inflation, which is something that people have been talking about for the past 18 months. I think that, if you look at kind of history, the odds of a soft landing would appear to be zero, because we have very high levels of inflation, very low levels of unemployment. There's never been a soft landing in that type of environment. And that's, what people like Larry Summers have been telling us for the past 18 months, that a soft landing is impossible. I actually think the odds aren't that bad. History isn't a good guide. And I hesitate to say this time is different, but, we haven't had an economy like this before. This is the weirdest economy I've seen in my career. And I've been doing this 20 years with these massive distortions. And if, the recession risk, the hard landing risk, is that central banks are just freaking out about inflation. So, if we keep getting nasty inflation numbers, they're going to push us into recession, because they'll just hike and hike and hike until we get that recession. And clearly, from the Fed, 75 basis points every month is a clear route to a hard landing. But I think, we can get some better inflation data. We must get some inflation data for any chance of a soft landing. If the inflation data starts to come off, and we've had 1 month of good data, that's not enough. Policymakers will be looking for minimum 3 months of improvement in inflation. If we get that, then I think that central bankers will start to calm down a little bit more, and then we'll be on a more gradual tightening path. And then I think, there is a chance that we get that sort of softish landing.
Hi, I'm Raoul Pal, the CEO and co-founder of Real Vision. The financial world is a complicated world right now. It's a really complicated macro picture, and there's a lot of risks. Real Vision and our YouTube channel help you navigate those risks. So subscribe now to the channel and never miss an update. There is simply too much going on. So subscribe now. Thank you.
If we look at the first half of the year, we got at least technical recession on paper in the US economy. So a small decline in the real growth in both the first quarter and the second quarter of the year. But you don't really seem to find that to be a true recession. So what's the difference between the recession that we saw on paper in the first half of the year and a true recession?
I think, a true recession, it when you see it. And if we're still arguing about technicalities of a recession, if the kind of bearish take on this economy is that technically the economy is in recession, I think that's pretty bullish, actually. I don't think we can measure it by what's happening with GDP. I think you have to measure it in terms of the labor market. And, when companies actually start to fire people, then you're in this really nasty feedback loop because, people lose their jobs, they become more uncertain, they spend less, so corporate revenues go down. So you get more rounds of job cuts, which then feeds on the effect again. And so that true recession dynamic, which you can, clearly see when it's happening, has a very different feel to it. And it's very dangerous for investors because it's just so uncertain. That kind of feedback loop is naturally very uncertain. And when you're in that kind of dynamic, you really have no idea, how far down you're going or how long the problem is going to last, which is why, risk premium in all sorts of assets then start to blow out. I just don't think, we're seeing that. And because we have these very severe labor shortages, particularly in the US and the UK, but also in other countries, I just think companies will be very reluctant to fire people. And so, the NBR, who are the kind of true guardians of defining US recessions, they pretend there's this huge science to it. But actually, you just look at employment. And when employment goes down, then the NBR always calls a recession. And, as I said, there's very good reason for that, because a recession that involves the labor market is very different to one that doesn't.
A lot of macro pundits have tended to blame politicians for the inflation mess that we're currently in, the fiscal response to the COVID pandemic, and the direct transfers to each and every household in the US as a few examples. Do you concur with the view that the current inflation mess is a result of the fiscal response from 2020 and 2021?
I think they overdid it. So, and if you want a policymaker to blame, I think you're blaming fiscal rather than monetary. I think the central banks were very effective at the early stages of this crisis when they effectively broke the feedback loop between financial markets and the real economy. So we were seeing these big declines in equity markets. We were seeing this dysfunction in credit markets. We were seeing a kind of run on the shadow banking system. And we were getting the start of a very severe credit crisis. We were getting a big appreciation in the dollar, which was compounding all of these dollar shortages in the global economy. We were on the brink of a very nasty financial crisis, and central banks effectively stopped that process by breaking those feedback loops. And then it was fiscal policy that came in and basically protected everybody's incomes and did a very good job of preventing what might have become a very serious recession or a depression. Did they overdo it? I think almost certainly they overdid it. I don't think we can really debate that at this point. I think that, the policy stimulus was very, very large, but also I think they got a bit unlucky because I think what most economists didn't understand during this crisis was the impact on the supply side. So they looked at it just as a kind of demand shock, a kind of 2008 demand shock. And actually it wasn't just about the demand side, it was about the supply side. And I think that economists overall, and particularly policymakers, didn't understand what stimulating an economy in a pandemic would have, the effect that would have on inflation. And I think if we hadn't have had, the big problems in supply sides, I think we would have had some inflation, but it wouldn't look anywhere near as bad as it looks right now. And certainly, I think there's a case that they overdid it, but you can kind of understand why they overdid it. And I do think there's a difference between the US and the rest of the world. So, the US approach of basically just sending out stimulus checks to everybody always seemed a bit bizarre. There were a lot of people that were working from home. They weren't commuting. They didn't need to spend out of their income in the same way. And yet the government was sending them these huge stimulus checks, which they just then pumped into the economy. In Europe and the UK, where we had these kind of job furlough schemes, it was a very different type of dynamic because it was much more targeted on the people that actually needed the fiscal stimulus. And it included a haircut. So if you think about those furlough schemes, they basically gave everybody a 20% haircut on their wages. So it was much more targeted. It was much less aggressive. And I think, looking back, the kind of European approach would have resulted in much less inflation overall if it had been adopted everywhere.
So it seems as if you kind of hint that we addressed a partly supply-driven issue with measures fit for a demand crisis in the US at least. So when it comes to the lesson learned from that, I guess we're still stuck in some kind of scarce supply scenario when it comes to energy. There is a risk of continued energy inflation into next year. Do you think we've learned anything from the COVID pandemic when it comes to the response to that?
It's difficult to take lessons. I think we've learned that policy is extremely powerful. The fact that we had the biggest shock to the global economy in 300 years, and we prevented that turning into a very serious recession, I think that shows you how powerful policy can be. The difficulty is that was a pretty unique situation because, you think about the global financial crisis, when that kicked off, there was somebody to blame for it. We all wanted to blame bankers. And so you had these big political divisions about whether whether we should be bailing out bankers. But with the pandemic, there was nobody to blame. This was a kind of classic act of God. And in fact, you had politicians telling people they had to stay at home and couldn't go out and work. So the politics of it, from a kind of stimulus perspective, were very, very easy. Nobody to blame. You wanted people to stay at home. You didn't want them to work. So you had to protect their incomes during that kind of event. The global financial crisis was very, very different. But also, you could see the effect that this was having on the economy. This was the first recession where you could basically look out of your window and see that the economy was in recession because everything just stopped. The global financial crisis, well into that recession, people were still arguing about whether there was going to be a recession or not. So, it's very difficult to assume that because of what happened in 2020, we can basically just end the business cycle now. Policy can always come in and prevent any kind of crisis because that was a pretty unique set of circumstances, and it's going to be very difficult to repeat those kinds of circumstances in the future.
When we look at the potential policy response to a winter of very high energy bills across the globe, would you then consider it likely that the targeted measures, the direct transfers, will become sort of a more permanent part of the toolkit when it comes to the fiscal response to the current inflation pressure?
Yeah, I think we've learned that these policymakers, particularly politicians, have a natural kind of bias towards throwing more stimulus at a problem. And we knew this, we knew this in the 70s and 80s, and it was something that we forgot. The fact that you have this kind of cost of living crisis, you have a high inflation problem, the natural response of politicians everywhere has just been to throw money at it. And, we've seen governments capping energy prices. We've seen them sending out direct transfers to people. So clearly, there is this kind of inherent bias in policy. I think that's probably something that's going to continue. It's kind of a lesson of, where MMT went wrong, because MMT argued that there would always be this ability to tighten fiscal policy if you ran into an inflation problem. And actually, we've seen, politicians dealing with this in a very different way. And they clearly have this kind of inherent inflation bias. And you contrast that to what's happening in central banks. I mean, and the Bank of England is the extreme example of this, because the Bank of England is basically saying there is this massive shock to people's real incomes. We're all going to be poorer because of this, and you guys have to just accept that. And if you don't accept it, if you try to resist it by demanding bigger wage increases, we're going to have to push the economy into recession. And so there's a very different approach from fiscal and monetary policy to any sort of inflation problem. And I think that's telling us something about that kind of inherent bias in policy. But I think you're right. I don't think that we can go back to austerity. I think the fiscal regime has changed. I just can't imagine that, we're going to go back to a decade of fiscal policy being very tight. There are big things that we're going to have to spend on over the next decade: inequality, infrastructure spending, climate change, defense spending. The fiscal regime has changed, I think.
If we look at the potential fiscal response this winter in Europe, I would like to point the needle towards France, because it's a very good example of a country with a big issue when it comes to the electricity bill. The forward pricing of electricity in France peaks at above 2,000 euros per megawatt hour for the peak load in December 2022. And I think that's around 1,000%, maybe even 1,500% above usual levels for the price of a megawatt hour. In France, there is a legislation in place capping the yearly increase in the electricity bill, I think at 4%. So let's assume that the French government will have to take this entire bill and protect the households. Will that lead to sort of a new vicious cycle of expansionary fiscal policy?
I don't think so. I think that actually, this is, it depends where the problem is coming from. So if this is a supply side problem, and in Europe, this clearly is a supply side problem. We have the war in Ukraine. We've had a massive energy shock that comes from that. It's a squeeze on people's real incomes, but it's a sort of temporary squeeze on real incomes. So if energy prices stabilize or eventually goes down, real incomes are going to rebound quite quickly. So I think there is a case for governments actually providing a kind of short-term stimulus to those people that need it. And it doesn't need to become inflationary. It doesn't need to fuel demand. The issue is when governments use this as a kind of broader inflation measure. So you take the US, where you've got a much clearer case of an economy that is overheating and demand is too strong. And it isn't just energy prices that are causing the inflation. If the US government was to try to help people in the same way by, again, sending money out to people, I think that would cause overheating demand to become even worse. So I think it depends on the particular country and the particular issues that they face. I don't think a short-term support from governments is going to be disastrous. But I think what this is really calling for is a kind of progressive policy. And what we're looking at here is a situation. You think about the last 2 years. I mean, they basically had, people like us on, relatively high incomes with secure jobs who could work from home, who weren't commuting, weren't traveling. So we spent all of our money on goods. We flooded the global goods system. The price of those things went up dramatically. And it was, low income people who had to continue going to work that got squeezed by that inflation. So I think, what you're really looking at is a situation where governments should try to act a bit more progressively and maybe redistribute money. But the issue is that it's the higher income people that actually vote. So, again, take the UK as an example of this. You have, this kind of prime minister, this contest to become prime minister. And they're basically just thinking up, ways to help wealthy people, over the next 6 months, which seems a bit bizarre, because if anything, what's happening now is sort of progressive in itself, because those savings that wealthy people accumulated over the past 2 years are now getting inflated away by the inflation that we have. And the wages that are going up right now, the kind of if there's any kind of second round effect, this is happening for low income people, particularly people in sectors that were most exposed to the pandemic. So the problem is sort of sorting itself out naturally. And if governments just come in and just do, completely broad-based tax cuts or fiscal transfers, then I think that's really helping.
I guess there's an old saying, and I quote an old trader now, saying that the cure for high prices is high prices. So let me play the devil's advocate a bit here. I, as an employee would either want a wage increase or the government to protect me against these rapid increases in, for example, the electricity bill. So if those are the two scenarios, how do we ensure that this doesn't turn into a sort of vicious spiral for inflation?
Because I don't think that the source of this inflation coming from energy is a sort of persistent source of inflation. I think this would come off by itself, and I think the effect is quite short term. So what we're really talking about is a kind of winter squeeze, particularly if Putin shuts off the energy in Europe. So we're talking about this, the next 6 months having this huge squeeze on people's real incomes. But the effect of that will fade quite quickly going into next year. So if policy does nothing, then real incomes will just rebound. So what you could have is a government that basically supports people during this 6 month period and then withdraws the support when it's no longer needed. And I don't think that sets off a naturally inflationary dynamic. I don't think that pushes you closer to a sort of wage price spiral than if they didn't do that. We're talking about a particular type of inflation coming from the supply side. We're talking about a relatively short-term problem, and there's no reason why governments couldn't absorb some of that in a bigger deficit during the winter. I don't think that's a sort of persistent source of inflation.
I want to throw a couple of very important long-term topics into the mix here, because we've debated over the course of the past 2 years whether the pandemic will lead to sort of a resurgence of the reshoring, or whether it will lead to sort of a more permanent move towards a deglobalization trend. If we add those two potential super trends to the mix, would that make you more worried about a new regime for inflation?
I think that we are entering a new regime for inflation. So, I think the inflation numbers that we've had over this, last 12 months have been massively distorted. So I don't think we're going to be looking at persistent, 8, 9, 10% inflation. But I think inflation will settle above where it was before the pandemic and before the war in Ukraine. So I think, we're looking at, it's the way I think about this is that, for kind of 15 years, we had this regime where the prevailing tendency of inflation was always to fall below 2%. So you had central banks that are obsessed with preventing the Japanization of their economy. They were obsessed with debt deflation. The slightest problem in the economy, the slightest problem in financial markets, they immediately stimulated as quickly as they could to try and break those dynamics. And I think we're looking at a world where the kind of prevailing tendency of inflation will always be to break above 3%. So it's not that we face these kind of permanent, 1970s stagflation, or that we face this kind of persistent wage price spirals. It's just that it's going to be a different kind of bias in inflation. And that's going to change the policy bias, because you're going to get central bankers that are much less sensitive to the real economy, as we're seeing already, through this year. And where, the whole kind of bias of policy shifts. And you get a sort of, instead of opportunistic reflation, you get this kind of opportunistic disinflation. So a very different type of dynamic. And I think ultimately, as you said, a big part of that is globalization, deglobalization, changing the kind of structural secular forces of the last 20, 30 years. But it's more than that, because I think about this in terms of the long super cycles. So we basically had 3 of these super cycles in the last 150 years. We had one from the kind of mid 1800s to the end of the Second World War. Then we had one from the Second World War until 2019, 2020, and then we have this new kind of super cycle. And ultimately, that super cycle is about the balance of power between labor and capital. When labor is on top, you prioritize low unemployment, you're more likely to get bigger wage increases, you're more likely to get more inflation. When capital is on top, you get low inflation, low interest rates, very different type of dynamic. And so, the last super cycle was the sort of post-1980s neoliberalism. We trashed the trade unions, we opened up global capital markets, we opened up the global economy, we had rapid levels of immigration. And that was, an environment in which capital was completely dominant over labor. Now, I think we're beginning to see this shift again for the first time since the 1980s. We're coming out of this crisis with severe labor shortages everywhere. We're going to get, this kind of move towards deglobalization. Part of that comes from the pandemic, because we've learned that these supply chains are inherently, unstable and precarious. Part of it is about the situation in Ukraine. We're kind of splintering geopolitically into these kind of trading blocks, US, Europe, China, Russia. And that's a very different sort of dynamic for the world over the next 20 years. It's a world where the balance of power between labor and capital starts to shift back to labor for the first time in decades. And so that's a world where, if globalization gave us, very low inflation, very low interest rates, very high levels of corporate profits, very low wages, we're beginning to, tilt that the other way. So inflation is going to be higher, interest rates are going to be higher, profit share is going to start to come down, wage share is going to start to go up. And then overlaying all of that, you have, we're going to have more defense spending, more infrastructure spending, bigger government deficits. We're going to have more interventionist governments. So think about the challenges that we face over the next decade. It's basically the kind of China, geopolitics, the defense spending, Russia, and then you have climate change. And both of those situations, kind of war and climate change, naturally demand governments to play a bigger role in the economy than we've been used to. So you've got this kind of broad attack on neoliberalism, and that's the thing that changes the super cycle. So I think this is a secular turning point in inflation, interest rates. And it's a very different type of world for investors too, because we're not just going to have perma zero interest rates and QE and continuous re-rating of asset prices like we had for the last 20 years. It's a very different type of dynamic.
I want to add the discussion on demographics to the mix in relation to what you just said on the labor shortage that we're faced with, paired with the potential for reshoring / deglobalization trends. If we look at the projections for demographics in Europe, first of all, I guess it's fair to assume that the labor force will actually shrink over the coming 20 to 30 years. Will that prove to be positive or negative for bond yields, given what you just described on the potential for a regime shift?
So I think the economics of demographic change is actually quite ambiguous. People think they know for sure that demographics is either going to lead to higher interest rates or lower interest rates. And the fact that they disagree, I think, proves that there's an underlying issue here. The problem is that you're going to have, you think about what determines interest rates in that kind of structural sense. It's savings and investment, or, more is actually desired savings and investment rather than just the level of savings and investment. And so the problem with demographics is that it causes both things to go down. We're going to have less spending. We're going to have, slower demand that comes from, people retiring and no longer having a wage income anymore. So they naturally spend less because their income goes down, but they spend a higher proportion of their income. And then you have governments topping up their spending through running deficits in order to fund their healthcare, fund their retirement. And so the net effects of that are actually quite ambiguous. And so, I've never taken a strong view on whether that part of this is inflationary or deflationary. But, we've seen during the last 2 years about the impact on the labor market, which is clearly inflationary, because what's happened over the past 2 years is a lot of older people have dropped out of the labor market, and that's caused this imbalance in labor demand and labor supply, and that's the reason that wages are going up. You think about the US. Labor demand is basically where we thought it would be had the pandemic not happened, because it's basically gone up in line with GDP, and GDP's gone up in line with its pre-pandemic trend. But labor supply is down. And labor supply being down over 2.5 year period is a really big deal, because we basically lost 5 million jobs compared to where we thought we would be. And so we're seeing these pockets of power in the labor market where people in areas like hospitality and travel, because a bunch of older workers have dropped out, they're suddenly securing these massive pay rises. So I think, if we're talking about structural labor shortages, I think demographics probably strengthens that process. So I'm now coming to the view that actually demographics is probably going to be net inflationary overall. And, that means that interest rates are going to be higher. It's another reason that's going to push us towards this sort of super cycle increase in interest rates.
Dario, is it even possible to reshore a lot of, say, manufacturing jobs to Europe or to the US if the labor force shrinks in 10, 20 years from now? What do you make of that?
Well, I think it's going to be harder. So I think that's the reason to think that this kind of structural hot labor market is going to become a theme for the next 5-10 years. But I think, we're definitely going to try, because everything is aligned towards reshoring now. So you have the sort of lesson from the pandemic, which is that, if you can't get hold of semiconductors, you can't build cars, which is a pretty strong story if you're a car producer. And so you have the kind of private incentive of these companies to try and secure their supply chains rather than just rely on, what's happening overseas. And then you have the political incentive to move in the same direction, because clearly, the politics of global trade is becoming more difficult. And this was true before the pandemic, before, the Ukraine situation. We saw that with Trump and with Brexit and with the kind of anti-EU sentiment in Europe. So we're really just accelerating that process. So, I think the answer is that we're going to try. And I think as an investor, you need to think, well, what are the implications of that? And to me, that is a structural labor shortage, higher wages, higher inflation, different sort of central banking. You wanted to talk about MMT, and if you do a search of my name on Google, MMT is now associated with my name, which is kind of funny. because I sounded quite sympathetic to MMT in the kind of depths of the crisis. Well, I think we were all MMTers, and the way that I expressed this, back in kind of 2020, is that we were having a romance with MMT, but it wasn't a marriage, because we still had independent central banks who had inflation targets. And you can't really live in an MMT world if you have an independent central bank with an inflation target that wants to raise interest rates. And so the way I think about MMT is that it was unambiguously right when interest rates were zero. And so for a decade, MMT got everything right. They got QE right, which they said wasn't a big deal, wouldn't be inflationary, wouldn't be hyperinflationary. There were people in 2009 who thought that QE would be hyperinflationary. They got the euro crisis right, because they said that, you needed somebody to stand behind periphery debt, particularly the ECB. And that was the role of the ECB. So they called that right. They got the Trump stimulus right. They said that wouldn't be inflationary. It wasn't. They got austerity right. They said that if we went down the austerity route, we would end up with, permanent zero interest rates and deflation. And that's exactly what happened. And the politics of that was disastrous. So for a decade, MMT got absolutely everything right. And there's a really good reason for that. Interest rates were zero. When interest rates are zero, you don't get bond vigilantes. You don't get any pressure on central banks to raise interest rates because of inflation. There was no inflation. So my point, back at, 2020, 2021, was that MMT should have been mainstream economics. They were basically the same thing. When you're kind of equilibrium interest rate, or R star, as economists like to call it, when that is zero, MMT should be mainstream. And that's the reason that MMT got everything right during that 10-year period. The problem with MMT is it had an inherent inflation bias. Because, once you relied on politicians to, decide whether you had too much spending in the economy, the politicians were always going to do too much. And, that's been the lesson of the last 6 months. They see a problem, they throw money at it. And central banks have taken a very different view. So there was this kind of inherent flaw in MMT, because it sort of contained the seeds of its own destruction. And so, they were right that it wasn't the bond vigilantes that were keeping interest rates low. It was inflation. The issue is that when inflation has come back, as it has, the MMT solution is completely different to the mainstream solution. So that's when you get the disconnect between MMT and mainstream economics, because MMT will come up with any other policy apart from raising interest rates. Because to believe in MMT forever, you have to believe that interest rates are at zero forever. All that stuff about debt and money financing being the same, that all relies on interest rates being zero. And so, they were right about what the constraint was on governments, but they had this kind of inherent bias that would break us out of those constraints. And that's where we've ended up.
And ultimately, Dario, I think you need to ask yourself the question whether you rather prefer to trust a politician or a central banker with the job of breaking inflation's neck. And you cannot answer none of them.
Well, I used to joke that I wanted to live in a world where politicians believed in MMT and central bankers didn't. Because, we'd lived in the 2010s. In the 2010s, we had this really toxic policy mix. We had austerity at a time when fiscal policy was very, very powerful. That kind of constant restraint on the public finances was having a real economic effect on our economies, and you could see that, and it was showing up in things like inequality and polarization and stagnant wages. And we had very easy monetary policy at a point where monetary policy was totally ineffective because interest rates were at zero. QE did nothing. I'm a massive QE skeptic. I think QE was basically a huge waste of time. And so that policy mix was naturally deflationary and toxically, it was very toxic politically. And so, that world was the reason that we had interest rates at 800-year lows was telling you that there was something really profoundly wrong with the policy mix. And so, I joked that we wanted to live in a world where actually fiscal policy believed in MMT and they wanted to stimulate and stimulate and stimulate in the way that MMT seemed to be pushing us, particularly given the challenges that we face over the next decade from globalization and from climate change and deglobalization and sort of defense spending. So we actually need governments to spend in those areas. But we want central banks to react to that. We want them to be able to raise interest rates and actually, cool the economy down when it seems to be overheating, because we know that we can't rely on the politicians to do that. So actually, from a kind of optimistic take, is that we've moved into a world where the policy mix is much more sensible than the policy mix that we had over the last decade. And that, I think is a positive thing, because it means that, we're going to get reflation, we're going to get higher wages, but we're not going to get the sort of wage price spirals, the sort of 1970s dynamic that people have been so fearful of during the first half of this year.
So this exact mix of tighter monetary policy and easier fiscal policy is probably the mix to expect for the next few decades, Dario?
I don't know about a few decades, certainly the next decade. There's stuff that we have to spend on, and monetary policy can't deal with those problems. We have serious inequality. Monetary policy is not a solution to inequality, probably makes inequality worse. We have this climate crisis that is going to require massive increases in public investment. Again, that's not something that monetary policy can or should be trying to deal with. And we need massive infrastructure spending, because that decade of austerity, particularly in Europe, just saw the kind of infrastructure of most economies absolutely crumble. And, for the euro area as a whole, over a 15-year period, there's been no net public investment, which is just bizarre. How can you have no investment over a 15-year period? And so, I think that these are the challenges that we're facing over the next decade. And fiscal policy, can try to deal with those challenges. But, we don't want to be in a situation where we're just in this kind of, fiscal dominance where central banks can't raise interest rates and interest rates are at zero. So that policy mix, I think, is very favorable. But I think investors are really worried about that. They look at this environment, they think, oh my God, inflation is going to be higher, interest rates are going to be higher. We're going to have more interventionist governments. Maybe efficiency is going to go down because we're going to be shrinking supply chains. Most investors are absolutely, panicking about what this new world is going to mean. And the fact that the profit share goes down is clearly not good for equities. But I don't think this environment is actually bad for financial markets. I just think it's different for financial markets. So if you think about the last decade, what did you do as an investor? You basically just put your money into US tech, because you had QE, you had perma zero interest rates, everything just got re-rated. So you could be a financial genius just by buying FANGs and watching them rise, 20% a year. Investing was quite easy. I think that the next 5-10 years is going to demand a slightly more sophisticated approach to investment. So investors are going to need to look for exposure to the real economy. They're going to need to identify, where are the kind of growth opportunities for the next 5 years, areas of defense spending, areas of, the green transition, the reshoring, how do you benefit from reshoring as an investor? Where are the sort of investment opportunities in that? It's a very different type of dynamic. And, one way to think about it is that you think of it in terms of sectors. So for the last decade, growth stocks just massively outperformed value. Most value investors got absolutely hosed over the last 15 years and just felt completely frustrated and slightly annoyed that these younger investors were just buying FANGs and outperforming them. And actually that 10-year period was really bizarre because, we have data on value and growth sectors going back to the 1940s. And that 10-year period is the only period in history where you see that massive outperformance of growth over value. And it was the nature of this bizarre economy that we're in, this messed up policy mix, these zero interest rates, these QE, all of that stuff is gone. And so I think, this is a world where value investing starts to come back. So if you think about the next 5 years, what do you want to invest in? You want to invest in commodities because we're going to have massive commodity shortages from pretty much all of this, defense spending, infrastructure spending, the green transition, all of that is about commodities. We're going to have countries actually, trying to restrict the supply of commodities because of this kind of resource nationalization that we're going to be getting, from these different trading blocks and this kind of Cold War. I think you want to be invested in value stocks. I think there's still a role for bonds. So, I don't think we're in permanent stagflation. So I think there's still going to be a helpful correlation between bonds and equities. When you get a recession, when you get a kind of panic in financial markets and equities go down, there's still going to be a sort of insurance hedging property that comes from bonds. But over a 5-year period, I think returns in bonds are just going to look horrible. I think real returns in bonds are going to be nasty. And we're also, even if we don't get, really high inflation, persistent inflation, we're going to get much more volatile inflation because we're going to have big commodity shocks. We're going to be moving to intermittent types of energy, which are going to be much more volatile. So you're going to get big swings in energy prices. We're going to be, we're going to get more disruption from climate change. So the actual physical effect of climate change is going to be, to cause more supply disruption, more droughts, more famines, more of that kind of stuff. So all of that is going to make inflation much more volatile. So this period of transitory inflation that we've had this year and last year, we're going to get more of that. And we're not going to have central banks reacting to every transitory swing in inflation. So there's going to be a bit of financial repression that goes on in those periods. And so real returns in bonds just get absolutely killed, I think.
I think that's a very fair assessment, but also quite a piece of bad news for my so-called buy the fucking dip asset allocation right now. And I wanted to ask you about that ultimately here, Dario, because when we had this regime shift after the great financial crisis, it kind of took a while before we agreed upon it being a new regime of zero interest rates, etc. At which point do you think we will be able to agree that we've entered a new regime inflation-wise this time around?
I don't think we're going to get any clarity for the next 6 months. So, we have this sort of recession scare right now. That sort of pendulum between inflation, new regime, and recession, old regime, it just keeps swinging, and it has been swinging at this kind of 6-monthly interval over the past 2 years, when it used to swing at this kind of 2-year interval, and before that, even longer interval. And so at the moment, we're swinging back to recession scare. We're seeing commodity prices come off. You've got the peak inflation narrative coming back into financial markets. But I don't think we're going to get this sort of head clutching recession. So, if we had, a massive recession now, that would bring a bit of clarity to this dynamic. We could all agree that we're in a recession and things are really bad. I think we've got this fake recession. I think actually growth will recover next year in a way that people aren't really anticipating. And so we're still going to be swinging along this sort of pendulum. So I think we're not going to get any clarity on this for the next 6 months. I think both kind of bulls and bears are going to be frustrated by this. This sort of messy, distorted economy of the last 2 years is going to continue. And, for the last 2 years, I've had, one question from investors, which has always been, where are we in this business cycle? And my answer has always been the same. This ain't a business cycle. Nothing about this is a business cycle. So you can't call it late cycle. You can't call it early cycle. You can't call it mid cycle. This is massive distortions from a pandemic and then from the war. And, it's going to take at least 6 months to sort of figure out what the economy looks like on the other side of this. And so that's why, I've been saying to investors, this thing is going to keep swinging. You're not going to get any clarity on this. It's going to be very messy. There's going to be a lot of volatility there. So if you want to trade these sort of short-term, the kind of peak inflation narrative, you can trade that short term, but we're not going back to zero interest rates. We're not going back to 2% inflation. And so, it's just a world of distortions and mess. And so I say to investors, try to look beyond that, think about what the economy is going to look like on the other side of this, and position yourself for that. Because if this is a super cycle that is turning, there are going to be big opportunities if you get that right. And, that's going to be much better for your portfolio than trying to figure out whether this is peak inflation or not, because that stuff is still massively up in the air.
Dario, any final thoughts for the audience?
There's one final thing I want to talk about, which is this disconnect between what a pivot means, which is it plays into your, how do I play this over the next 6 months? Because the market and central bankers have a very different view on what a pivot means. So if you look at the bond market, it's basically saying that the Fed will be cutting next year, and that's the pivot. But actually, if you read the minutes from the Fed, they're seeing the world very differently. They're saying, well, at some point, we're going to slow down the pace of tightening, but we're still going to maintain this tightening bias. And so, very different definition of what a pivot means. And then the peak inflation narrative, you have, markets going bananas because of one, very good inflation print. But if you're a central banker, you're looking for at least 3 good inflation moves. So, that kind of uncertainty is still going to be lingering over this period. I just don't see any of that getting cleared up. And there are these kind of basic disconnects between where the market is and where policymakers think we are still.
I guess I'll allow the sort of debate to conclude with those remarks, Dario. I'll call you in 6 months to see whether we have any clarity at that point. But thank you so much for joining the Real Vision platform to talk about the fiscal response during COVID and the distortions made by the pandemic and whether this will turn into an inflationary regime shift. It was a pleasure to talk to you.
Nice to talk to you. Thanks for having me on.
What a great discussion with Dario. And I think one thing is very clear after this debate. Inflation has entered a new regime as a consequence of fiscal policy being a more or less permanent part of the policy mix by now. We should expect larger fiscal deficits. We should expect reshoring trends. And we should expect the labor market to outpace the capital market when it comes to the negotiation or bargaining power. And that matters a whole lot to the inflationary outlook for the coming decade. So the low inflation environment from the 2010s, well, that's probably a thing of the past, if you ask Dario Perkins.
Hey there, revolutionaries. To join a community sharing insights like you just watched, head over to realvision.com. There you will get unbiased insights and exclusive access to the very best, brightest, and biggest names in finance. Be a part of our community of lifelong learners. See you there.